Good morning and welcome to this Monday, July 27th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, Friday was a little bit of a rough day, but this morning we do see futures up a little bit more on the NASDAQ than on the Dow and the S&P, but I am looking mostly at green. Got that 10-year Treasury yield still down, though, down another 1 basis point today, just under 0.58%. Gold, which has been on a big run, up another $30 this morning, breaking above 1,900 per ounce, so it is now up to 1,928. Silver up another 6%, $24. Copper making a little bit of a move at 2.89. Really, commodities across the board doing exceptionally well. Even crude oil up about 0.5% today to $41.50 per barrel. The dollar's down again, and this is going to be a theme as we go into the balance of the summer and into throughout the second half of the year. If the dollar continues to weaken, that likely will change the relationship between the sectors, what's outperforming, what's underperforming, and so forth. So it's something to really keep an eye on. We closed last week on the dollar very close to a key trend line, and with it being down again this morning, that could be a problem for some areas of the market, could bode very well for materials and energy stocks. Materials already have been picking up the pace on a relative basis, and based on all of those commodity prices I just discussed, there's a pretty good chance that we're going to see another strong day today in materials, at least at the open. Let's go back and take a look at what happened on Friday. But first, before I do that, I do want to just point out to everyone that if you are not currently a Earnings Beats subscriber, you're not in our community, we'd love to have you. We do have a free Earnings Beats Digest newsletter. It goes out every Monday, Wednesday, and Friday morning. Very educational, normally discussing something about earnings, relative strength, could be a trade setup. I think you'll enjoy it if you're not already part of that community. Just type in your name, email address. You go over to earningsbeats.com to get to this page. It's just simply our homepage. Hit that subscribe button. You can unsubscribe at any time. There's no credit card required. We'd love to have you as part of the community. It really is a little bit of an introduction to who we are at Earnings Beats and the way that we look at the market. If you like what you see and you want to give us a try on our service, our paid service, you can click the Join Today button, go through and take a look at some of the things we do. I think our record speaks for itself as you look down at our portfolios and how we have performed relative to the S&P 500. I think it's pretty solid action. And, in the first 30 days, I think you'll get a pretty good sense of how we look at the market. So anyway, check that out. This the paid subscription really is a no cost. You do pay $7, but we refund you the $7 for your first 30-day trial. And then you get an idea of whether or not this will work for you. And by the way, our portfolio selections, these are all 10 equal weighted stocks that we pick every 90 days to go into these portfolios. And the reason we do it every 90 days is simply to always stick with the leaders. We're always looking at relative strength. We always want the leaders in our portfolios. We get these from 10 different industry groups. And so we try to diversify somewhat, but we do stay with the industry groups that are working. And so it's just a constant 10 stocks, hopefully working in your favor. But there's the performance. The next selection, the reason I mention this, the next selection day will be on August 19th, which is less than 30 days away. So if you do subscribe to a trial, that will cover the next period when we have these the announcement for these portfolios. So it's a great time to check us out if you haven't already. All right, let's take a look at what happened on Friday because it was not a very good day. You can see the Dow Jones Industrial Average down 182, the S&P down 20. The NASDAQ on a relative basis hit a little bit harder, down almost 100. You can see now that we are down about 600 points off the recent high, but we were very stretched. I mean, it's okay to come back down, have a little bit of profit taking. It's the summertime. We talked about last week being one of the worst weeks of the year historically. We had a great start on Monday, but after Monday, it was all downhill for the most part last week. And that is does kind of play along with the historical norm and the historical tendencies that we see. And we're also in this summertime period where, you know, if you're going to talk about a period to go away in the market historically, it's right now, June 17th to July 27th, or excuse me, July 17th to September 27th. I'll get all my dates right here before the day's out. So July 17th to September 27th, if you go back on the S&P 500 since 1950, so 70 years, that's pretty representative. This is the worst period of the year historically. Forget about the go away in May. There are many reasons why you don't want to go away at the beginning of May. Mostly because May and June and the first half of July really aren't that bad of months. I don't know, it just sounds good. It's got a nice ring to it. But really the period you want to be careful is when we get into the heat of summer, July 27th, or excuse me, July 17th to September 27th. I'm going to have myself confused about the dates here in a minute. Mid caps, small caps also down on Friday. Small caps actually the worst performing group, but all of the groups except, believe it or not, the NASDAQ. The NASDAQ's the only one below the 20-day moving average. It's been a while since we've said that. But all the other major indices now are above their 20-day, except for the NASDAQ. But the 20-day was rising a lot faster on the NASDAQ, so it didn't need to have much weakness to get down to that 20-day, but it did on Friday. Discretionary stocks, the only group in positive territory. There was your lone shining star from Friday. Discretionary stocks were up fractionally, less than 0.25%. The worst groups, technology, healthcare, industrials, and utilities, all down. And you want to know why the NASDAQ lost its 20-day moving average? All you got to do is look at technology. Technology failed to hold its 20-day moving average. Really, the biggest breakdown we've seen since we claimed above the 20-day moving average back in early April. I would say that the action at the end of last week was the worst since then. But we're going to get a 50-day test at some point. We've gotten it. I think technology is in a consolidation period now. I think it was a buy on rumor. And as we've seen so far, sell on news. As many of these companies have come out with strong earnings, we have seen a lot of sell-offs. I mean, we can look at Tesla. Obviously, there was a big sell-off there after earnings. We could look at Microsoft, big sell-off there. Netflix, big sell-off there. It's not a shock to me that the NASDAQ is struggling here because we had such big news built in to these stocks. So if we can't break out, and this is going to be a big week coming up. I mean, we've got some serious earnings news coming out. Companies that have been leading this rally to the upside. I mean, talked about a few that reported last week. But this week, the number is really going to grow. First off, tomorrow we've got AMD, which will be reporting. And, of course, Intel just laid an egg on Thursday. And while that took Intel down, that AMD surged off of Intel's weakness. So we've got AMD reporting Tuesday. Let's see what they come up with. Dexcom, a medical supply company, maybe the best medical supply company out there. That stock's been on fire. They report Tuesday. eBay's come to life since the pandemic hit, and eBay reports tomorrow. A couple of specialty finance companies, SPGI and MSCI, both report tomorrow. A home builder, Danaher, or I always get those two confused, D.H. Horton, or D.R. Horton, there we go. D.R. Horton, DHI reports. And then Massimo, another company that had been leading, has been consolidating, will be reporting tomorrow. Not to mention McDonald's, Starbucks, Amgen, a big biotech, Visa. That's just tomorrow. How about Wednesday? Facebook, PayPal, Shopify, Boeing. How bad are things at Boeing? We're going to find out Wednesday. ServiceNow, NOW, Lam Research, a leading semiconductor, Spotify, Teladoc. That's all Wednesday. And then the big ones come up on Thursday. How about Apple, Amazon, and Google? All three reporting on Thursday. So if you think the fireworks were last week, I got news for you. This is going to be the week that you're going to want to really pay attention, because if the NASDAQ and these stocks continue their recent trend of selling off with earnings, then there's no doubt we're in for consolidation for a while. Because what's going to happen is the market is going to start looking toward next quarter. And there's already a lot of talk about some of the states, pulling back a little bit, instead of easing restrictions, they may be accelerating some of those restrictions in some of the states where the coronavirus has been picking up. and spreading more rapidly. So there's going to be some question marks. And so a lot of the good news already built in, we're going to want to be careful over the next couple of months. And by the way, the summertime is not generally the best time for technology to begin with. So a lot of good stuff already built in, and it could be a period of time where we just consolidate. And if the dollar breaks down, rather than the market falling apart, which I think a lot of people think will happen if technology pulls back, I just simply think money's going to rotate. And so we're going to see areas of the market that maybe haven't been very strong all of a sudden get a lot stronger over the next couple of months. That could include energy and materials. It could include financials and industrials. We've got, and I could go on and on. We're going to get into some charts here in just a minute. But we've got the Fed meeting. That starts tomorrow. What's the Fed going to do? How are financials and industrials going to react? There's a lot going on this week. And seeing how the money rotates is perhaps going to be pretty important for us for the next month or two. All right, let's go ahead and move on. 10-year Treasury yield. So the only economic news out this morning was durable goods. So June durable goods rose 7.3%. Market was expecting 6.5%. Durable goods, if we strip out those transports, were 3.3% rise. And the market was looking for 3.5%. So headline number looks better than expected. Strip out transports, a little bit less than expected. Still strong numbers, but this is a very volatile report. So we might see a huge rise this month and a huge drop next month. You really got to look at durable goods over a period of months and kind of smooth it out. As I mentioned, FOMC meeting this week, that starts tomorrow. And then Wednesday at 2 o'clock, we'll get the latest policy statement. And then on Thursday, I believe it is, Q2 GDP is coming out. First estimate of Q2 GDP. You know what the number is, what the estimate is? Minus 35%. Now, Q1 was minus 5%. So obviously, we are going to have the definition of a recession. 2 consecutive quarters that show negative GDP. I don't think anyone is expecting this number to be positive. So minus 35% is the estimate. And then part of that report is Q2 consumer spending, and that's expected to drop 33% in Q2. That's the initial estimate of the drop there. Q1, the drop was 6.8%. So obviously, Q2 was a rough quarter. We already knew that. Market expects these bad numbers. Anything coming in better, obviously, could help the market. But we'll see what kind of reaction we get to that later in the week as well. And in the meantime, you can see 10-year Treasury yield. Let's get an update, get the latest here. 0.577, so just under 0.58%. We have been moving lower. And as we've been moving lower, kind of surprising, but financials are starting to show some strength. And I think part of it is that we've been losing some strength in technology, and the money just doesn't want to sit on the sidelines. So it's looking a little bit for value. And right now it's finding it in financial stocks. Now, if the 10-year Treasury yield keeps going down, you can see as it goes down, we tend to struggle in financials. So if we keep rolling over, I don't expect this short-term move in financials to the upside leading on a relative basis to continue. But one other thing, and I've pointed this out, I'm going to keep pointing this out. I think this is really important. Everyone needs to be paying attention to this. The 10-year Treasury yield in the U.S. versus Germany's 10-year Treasury yield. Why is that important? Well, it really does do a pretty good job of directing the dollar, what we should be expecting in the dollar. When our yields are moving faster than Germany's to the upside, when that spread is getting wider and wider, it's telling us our economy is stronger than Germany's. And when our economy is stronger than foreign economies, our dollar goes up. And you can see it right here in this chart. As we're going up, the US dollar has been in this nice uptrend. Then we came down, the dollar kept struggling, but kept trying to go up. And now you can see the dollar following suit. And that's been the history. These green shaded areas show the yields going up in the US faster than Germany. We would expect the dollar to go up, but these were periods where we actually had inverse correlation. In every one of those cases, the dollar came roaring back. This inverse correlation was the opposite, where the dollar kept going up, but the signal was that it should be going down. And you can see the inverse correlation again. Now what's happening? The dollar is playing catch up. So I'm watching this consolidation here because depending on which way we go, with yield in the US versus Germany, I think is going to dictate quite a bit about whether we should expect this trend line to break. Now, right now, I think we've played catch up, and now we're down to this trend line. And by the way, a trend line is not the same as price support. And what I mean by that, price support, I can tell you to the penny what price support is. Trend line, you can kind of, I can move this line to connect exactly this low, and then this one doesn't touch. This one would have to go all the way down below 94 to get to it. Or I could say, well, I really want to just go from this low to this low here. And now it looks like I'm trying to, I'm starting to break down. Now I could also start from over here and go through a little bit above that low, connect this low, and be right there. You see what I'm saying with trend lines? Depending on how you want to draw your trend line, could tell you that, hey, we just broke down, or that we still got room to go before we actually hit the trend line. So what I'm looking for is a real definitive break. I don't want to go just a little below this trend line. I want to see this thing down at 90, because that to me would be a very definitive break. Probably would lead to tremendous outperformance in materials and energy. And then when the dollar has its oversold bounce and materials and energy pull back, that will create some great opportunities. But the first thing is, does this dollar hold? If the dollar holds, if you start to see the dollar, and we've got a big Fed meeting coming up this week, that could have a big impact on how our rates are versus Germany's. And if we start to see the yield here in the US pull back away from Germany and this start to rise, then I would start to believe that this trend line is going to ultimately hold. Or if we do have a break, a slight break, it could be a head fake. So this is a pretty important chart to be following. And the significance, again, is here's that dollar. Here's the weekly 20-year chart. When the dollar's going down, materials go up relative to the S&P. Energy goes up relative to the S&P. When the dollar is going up, materials go down relative, and energy goes down relative to the S&P. Now, do you see this move down here just since March in the dollar? Look at materials. Now, energy hasn't really done much, but materials on a relative basis have been strengthening. And this is what a lot of people are talking about right now. And the reason is the dollar's going down. But my question is, we saw the dollar falling apart in 2017, early 2018. And throughout 2017, materials were rising. Now, 2018, they started to roll back over. Maybe it was in anticipation of that trend line holding, who knows? But my point is, when the dollar bounced off that trend line, you can see what happened to material. So anybody jumping in to materials in 2017 because of this steep drop in the dollar, they were burned. So I would just be careful about chasing this rally in materials. It's okay to get into materials. I'm not saying don't get in. I'm saying keep your stops in place, because if the dollar bounces, materials roll back over, I want to make sure that I get stopped out with relatively minor damage. So it's okay to be in materials, find it, and I would look for leading stocks, not any old material stock. I want to find the stocks that are leading materials. And if they pull back, hit a key support level, 20-day, something like that, I'd be fine with taking a position. But you want to keep that stop tight. I would keep it much tighter than I would other areas of the market that have been leading for the last 8 years. All right. So let's take a look at the S&P 500 and let's look at these individual sectors, okay, and how they're performing relative to the S&P. Now, this is a long-term 10-year chart, the S&P going up, up, up. Technology been a leader. Now, yes, last week was rough. So far this month has not been great for technology, but it's relative profit-taking. Look at the strength in technology. I mean, when you get a move like this, you have to expect at some point money's going to rotate out. People are going to take profits and move into other areas. And so we're seeing that a little bit. And to be quite honest, this might continue. I think this week is going to be big with a lot of those big technology companies reporting. If all of a sudden they cannot continue, if they come out with great news and the market sells off, then I think we're going to be in this period of churning on the XLK. And if the S&P goes up, then that's going to result in underperformance on the XLK. So don't be shocked if we do pull back. I still would not be leaving technology. I still think technology is an area that you want to be represented. I just don't know that I would be completely overextended in this group right now, because the summertime could result in a little bit more relative weakness. Look at consumer discretionary though, making a huge move. Now, some of this is Amazon related. Amazon, obviously a big part of the XLY, but Amazon pulled back and XLY moved up relative to the S&P. So obviously there's other strength in the XLY as well. That doesn't look to me like something I would expect if we're getting ready to head into a really rough patch in the market. I would not expect consumer discretionary because, to be outperforming, because consumer spending in a rough patch in the economy, you wouldn't think consumer spending is going to be there. Now, there are those who might say, well, the Fed this, the government stimulus, blah, blah, blah. Well, that's part of the market. I don't think you can go back to your broker and say, well, those stocks, my stocks that I was shorting shouldn't have gone up because the Fed, government stimulus, go ahead and just credit that cash back to my account because that really shouldn't count. Well, it's all part of the market and it does count. And when you've got the Fed supporting the market and you've got government supporting the market, I don't know why you would want to bet against that. I mean, we're talking about trillions of dollars supporting the market. Don't fight the Fed. Don't fight the government either. When the government's pouring money and putting money in consumers' pockets, you might say, well, eventually it's going to, kill the dollar. Well, maybe it is. Maybe that's why the dollar's pulling back. Maybe everyone's selling the dollar because that's what they believe. Who knows? But to me, again, what that means is that maybe if that continues, then we'll see some of the money rotating out of some of the areas that have been leading and moving into the materials. But for now, I would not be abandoning consumer discretionary stocks. How about communication services? And by the way, these lines, this blue dotted vertical line here, this is just 2020. So that's right at the beginning of the year. And then the red dotted line is at the bottom in March. So you can kind of see what's been going on throughout 2020 and also just since the pandemic hit. And consumer discretionary actually started the year off not that great. And then when the pandemic hit, look at the consumer discretionary outperforming. I mean, it's been arguably the best performing group since the pandemic hit. I think it's maybe even better than technology, especially with the recent weakness in technology shares. Communication services, though, very strong. Now, financials and industrials, well, these are more economically sensitive. Interest rates have been falling throughout the year. Normally, falling yields are not good for many areas of the financial world. Banks, investment services, asset managers, life insurance, all of those groups tend to do poorly on a relative basis when interest rates are falling. Right now, they're falling. So that helps to explain that. Healthcare, I think healthcare still remains in an uptrend. We did have this is huge outperformance at the beginning of the pandemic. We pulled back, hit this relative uptrend, and now I think looks to me like we're starting to show some relative strength again in healthcare. Now here's energy and materials. Do you see, here's the last 8 or 9 years on a relative basis going down. Doesn't mean they go down all the time. Here's a full year where energy was outperforming. Materials outperforming. 2 years really, materials were outperforming. But they rolled over and moved back down. So is this the bottom on a relative basis? I don't know. You'd have to be the judge there. My point is, let's watch what's going on in the yields. I think this is a big week with the Fed meeting, all these earnings reports. If the dollar does make a definitive break to the downside, then yes, I think that this move in materials may be sustainable. Doesn't mean that I would chase it. I would still be looking for opportunities. We got lots of scans we can run against chart lists and against, individual sectors, however you want to run them. But there are opportunities to get stocks that are pulling back. Not everything's going straight up. All right, let's move on. Earnings. Let's go to SAP. They reported. And they were up, I believe. They did beat on the bottom line, $1.29 versus $1.28. So they were up a couple percent pre-market. This is a really nice looking chart though. Huge move up. Look at it on a relative basis versus software. It had been in a downtrend for many months, probably 6-7 months. But back in May, right here at this low, when we started rising, we've been up 50% in the last 2 months. And the stock's been showing a lot of relative strength. They came out, they beat, stocks up in pre-market, but it needs to get through about 165, 165 and a half. Otherwise, I would probably look for a little bit of relative consolidation. All right, how about RY, AAY? This is Ryanair. And Ryanair, you can look down here at the airline group. Obviously, no strength over the last month and a half or so. A lot of the S&P 500 value stocks, or stocks that were really beaten up during the pandemic, rose during these 3 weeks, mid-May to early June. Well, a lot of them have started to rise again just recently when we've seen the money rotating out of technology. But look at airlines. Airlines have not. So this is a group that initially got that bounce, but since then it's just been working its way down. Now, Ryanair has been one of the better performers versus airlines. So we have seen a little strength here as airlines have drifted lower. And so on a relative basis, we've been seeing strength. They did come in and beat. They had a loss of 93 cents. The market was expecting a loss of $1.45. That's the good news. The bad news, pre-market, when I looked, they were down 6%. So you're talking about $4, $4.50. So we're probably maybe 69 or so. Could be down below these moving averages. Watch that gap support around 68. If that fails, we could move right back down to 64. Hasbro reported this morning. Hasbro, you can see accumulation distribution. This has not been one of the better stocks in the toys area. You can also see it down here in relative strength. They missed on their earnings. They came in at 2 cents. The market was expecting 19 cents. And in pre-market down 5%. So we're talking about what? That's another $4 or so, $3.80. So that would take us down to 73, maybe just below $74, right around that 50-day moving average, which is 74.07. I would be careful if it loses $70 on a closing basis. So it's kind of in a trading range between 70 and 85. As it gets close to 70, you could take a shot if you want. Wouldn't be one of my favorite plays, again, because of the lack of relative strength. But be careful if it fails to hold that $70 support area. RPM, they came out, they beat easily, $1.27 versus, 113 versus 101. Stock's up a couple percent pre-market, so we're getting a breakout. Got a little bit of a breakout on Friday. Looks like on a closing basis, we broke out, volume was picking up. So definitely there were some expectations. This is in the materials area. So this is going to be a stock definitely to keep an eye on. If with materials doing well, this could be a stock that runs. I would just say this, if I got in on the earnings, because the earnings beat were in breakout territory, I would just save a little bit of powder, maybe half a position in case we fail. Many times stocks report after earnings, everybody buys them at the open, and then they come back and maybe hit that 20-day. I would just keep some powder dry on RPM just in the event that we do pull back. One other stock here reporting earnings this morning, Legg Mason. They came in, they matched estimates 71 cents. The asset managers group, you can see leveling off, not quite up to that June 8th high. Legg Mason's been pretty much just going sideways here near that $50 level on a relative basis, has been lagging. Not a very encouraging report, in my opinion. Again, a lot of big earnings reports coming out this week. I'm not going to go through them all, but we do have Starbucks coming up tomorrow, eBay, Dexcom, Wednesday, Facebook, and PayPal, Shopify, Boeing, Thursday, Apple, Amazon, Google, Eli Lilly. Actually, Thursday, a big day for some of the other biotechs and healthcare stocks. We got Eli Lilly, AstraZeneca, AZN, Gilead. So AZN and Gilead both in that whole vaccine battle with coronavirus. It'll be interesting to hear from them. But also Vertex, Seattle Genetics, a couple of early companies in that biotech area that have done very well on a relative basis since the pandemic began. All right, let's take a look at the 3 you must see and wrap this thing up. There were 3 stocks I looked at that were in downtrends at the end of last week, and I want to watch these to see if they reverse. One is ELF. Check out, it's been going down and down. Look at the volume, has been much lesser. Are we going to bounce off that 50-day? I think a move below the 50 and then a move back up above Friday's high, I think would be very bullish. Even just moving above Friday's high could be the reversal signal off of this move. So ELF is one that I would be keeping an eye on. This stock showed really good accumulation distribution until just recently. We've pulled back some, but we were at a high, 52-week high on the AD line when we set this new high, and you can see the volume picked up here. So this pullback, we had a negative divergence, higher price, lower PPO. Now we've got the PPO back near the center line. This is a stock that could look interesting. I'm going to update it now that we've just opened the market. Not seeing anything here just yet. Maybe see if an intraday chart shows anything. No, not showing anything yet on that one. We'll have to wait and see. Next up on a daily basis, EverQuote, EVER. This is actually in one of our portfolios. It's been very weak of late, but it looks like maybe it reversed on Friday. This is a key area of support that I pointed out to our members in our portfolio report this weekend. But I think we could bounce on EverQuote from here. We'll see. And then the last one is Sleep Number. Sleep Number coming down, and you can see this was an area of resistance right here at about 43 and a half. And we've been coming down we were up to 55 just a week and a half ago, 2 weeks ago. And now we're down at 44. Volume's been much lower here of late. Also, look at the AD line. Very strong. Just a week or two ago, it's pulled back near a support level. These are all stocks that potentially could be on that downtrend reversal scan that we like to run because they've all been showing at least 5 days in a row of lower highs. So this is a good scan to pick up stocks, especially if they just start to turn back to the upside. So those are three that I thought you might like to see. All right, that is it. We're going to wrap up. I'll be back later today with my daily market report for our members. If you're not a member, give us a try. Go over to earningsbeats.com. Check out our 30-day trial. It's $7, but we'll refund it to you, so it's really no cost. I think you'll enjoy our service. You'll be able to download 10 of our different chart lists into your account if you're at least an extra member at Stock Charts. If you're not an extra member or you're not a member at Stock Charts, you can still view our charts. You just can't download them because you have no account to download them into. But it's a great deal. Check us out. And if you're not already an Earnings Beats Digest subscriber, that's our free newsletter. You definitely should check that out. As far as today's open, you can see the Dow right now down 10 points, S&P flat. NASDAQ showing a little bit of relative strength. And small caps up slightly, mid caps down slightly. Mostly just break even, showing a little early relative strength in those NASDAQ stocks. All right, that's it. Everybody have a great day, and we'll be back tomorrow over at Stock Charts TV for the next episode of Trading Places Live. Have a great day, everybody. Happy trading.